Vinit Sambre is with us, head of equities at DSP Mutual Fund. Vinit, good morning. Good to have you with us here. Thank you for your time. Prashant this side. Your thoughts, Vinit, on where we go from here. And there is, of course, the border issue that we've been talking about with so many experts, both military and, of course, market participants as well. What's the view within DSP from here?
So, Prashant, definitely, I think we are actually moving from one uncertain factor to maybe another uncertain factor. And there are, I think, today multiple things to sort of worry about. I would say that most important aspect from the equities viewpoint and slightly from a medium-term viewpoint to reduce the noise what we are having right now is the core earnings of the companies. And there, if we look at the result which are sort of coming up. We are not getting any great sense of growth sort of recovering back. We are I mean, this was expected as well. We are at single digit kind of growth rates. As far as earnings are concerned for most of the companies, and anyways, we have companies maybe also not giving out great commentaries as of now because the environment is a bit uncertain. So I would say that from our viewpoint, we are slightly looking at more medium term, trying to think beyond all these events. Maybe once we have the US tariff issues also behind us, this war related uncertainties behind us, and anyways, a low base of earnings would have got formed over the course of last 3 or 4 quarters. Maybe from there, hopefully, we should be thinking about growth. So I would say that. From our viewpoint, we sort of continue the kind of a cautious stance in the near term, and would say that maybe these volatile times should be sort of used more to build equities more gradually rather than getting on an aggressive basis. And definitely, the time horizons one should have in mind is really beyond 2, 3, 4 years, not having a very short-term time horizons in mind before investing.
Okay, got it, Vinit. Morning. Thank you very much for joining in. So you're saying, first of all, elongate your investment horizon at least 3, 4 years, if not more. And you're saying that maybe not the best time to go in lump sum. Take that point on board. Vinit, how do you look at the valuation of defense stocks? They have everything going in terms of, order books, definitely sentiment, the Make in India drive. So everything is positive. We just need to figure out if valuations and earnings visibility are actually somewhat in sync. What are your thoughts?
So I think particularly as far as the defense stocks are concerned, in terms of valuations, may not be absolutely reasonable or cheap, so to say, because anyways we have some kind of beyond fundamentals. The narratives have actually seen the price reacting from the lows, and maybe not exactly very comfortable in terms of the valuations. And the other aspect, if you generally think about the defense stocks, is that it runs with the order book inflows and sentiments, which generally assumption is that with whatever is going around should be positive, and hence maybe the stock price could continue to outperform in the near term. But we have seen for some of these companies, the execution cycle tends to remain pretty long. And from that perspective, the conversion of these order book coming into the earnings will be a matter of time. And once this narrative is behind us, and then people start looking at the core fundamentals, I mean, which is where the reality sort of hits. So I think the important point is that if somebody owns defense stocks in the portfolio, maybe good to ride as of now with the sentiments at the moment. But at certain price point, one should be thinking of maybe taking money off as well because of the long-term execution related challenges which these companies keep facing. Challenges, or maybe the slower rate of execution, what I wanted to sort of say.
All right. Hi, Vinit. Good morning. In fact, good to see you, Vin. Vinit, give us a couple of your sectoral calls. I recall that you had told us last time around that consumption is something you expect to pick up, and I think you'll have a fair bit of exposure out there. If you could tell us, as a percentage of the money you're managing, how much is consumption? And also, what do you like from the consumption basket?
Yeah, so actually, roughly between different funds, we'll have a consumption between 20-25 odd % exposure. And, when I say consumption broadly, these are largely on the side of discretionary. As of now, we have exposure to the auto ancillary, some of the retail companies, the textile kind of businesses. is part of them. QSR is also part of our consumption sort of basket. And I think the thesis is pretty clear in my mind as of now that consumption has been low in the low cycle for the last couple of years. Maybe the government has pivoted in terms of shifting the focus to consumption. With so many state elections coming up, I think the welfare kind of things are going to continue. Plus the tax benefit. I think all these things should add up, and eventually, whenever the pay commission happens, I mean, those will only add. So I believe in the consumption story. I believe that it's at the low cycle. On the low cycle, the valuations may not exactly look absolutely cheap or reasonable, but I would say that as the business metric starts performing, that's where maybe we'll start seeing the benefits. And hopefully, the assessment as of now is that maybe the second half should turn out to be better for some of these consumer discretionary companies as such.
Vinit, quickly, if you have a view on pharma, it's still evolving, the situation, but we saw that executive order on onshoring of pharma manufacturing, directions from US FDA on inspection on as far as foreign plants are concerned, more stricter, more costlier, unannounced. Any thoughts as a fund? What's your view?
Yeah, so see, I think it is slightly uncertain as of now with, let's say, especially the companies which are exports facing, and what exactly comes out from the US market is definitely going to have a sentimental kind of an impact. But I would say more long term, I believe the core competencies which are required for supplying drugs, which is your chemistry skills, your cost competitiveness, I think those we have, and I would believe that eventually this is what is going to matter. If you are useful to your customers and are able to produce at relatively cheaper price, I think that should eventually help. So maybe we go through some bit of that volatility, but I think in the long term, this is one sector which should definitely look good. And just remember that we are also going to go through this aging population kind of environment where today we have around, let's say, 9 to 10 crore individuals above 60 years, which are going to go beyond 14, 15 crores, and the requirement of medicines is only going to increase. So I think this is a more linear kind of a story as far as the segment is concerned. Companies do deliver decent ROCs. And beyond pharmaceutical, I would say there are other segments within the broader healthcare, like hospitals, diagnostics, where anyways there are opportunities. Maybe the only way to sort of deal with the higher valuations are maybe in bad time period should be the time to sort of add on to some of these long-term businesses is my thought.
All right, Vinit, thank you for all that perspective. We'll leave it there on that note today.
Thank you.
Thanks for joining in, and you have a good day.